Hi again, and welcome to the final episode of the Dutch Investors for 2025. This is part 3 of our investing lessons of companies we've analyzed. As we approach the end of the year, this is the ideal time to wrap up our investing lessons from 2025. In part 1 and part 2, we moved from pipes and toilets to Warhammer miniatures to mega yachts and Taiwanese chip fabs. No matter the company, we use the same process every single time. We put in the work, at least 50 hours of work per deep dive, with 3 pairs of eyes giving different perspectives and opinions on a company. In part 3, this one, we finish our lesson series with the companies we haven't touched on yet. Enjoy. So we pick up where we left off. Lesson 24, Small Market, Big Stakes. If you think about the semiconductor industry, companies like ASML, NVIDIA, and TSMC probably come to mind. We can imagine you're getting bored with hearing the same stories about the same companies in this industry over and over again. Luckily for you, this semiconductor company is quite different. Besi is a Dutch global leader in advanced semiconductor assembly, specifically hybrid bonding, which is the future of 3D stacked chips. Their machines are so precise, they align chiplets at sub-100 nanometer accuracy, a technical feat only a handful of players can deliver. The moat is undeniable, but Besi's customers, TSMC, Samsung, Intel, NVIDIA, are the most demanding in the world. But there is even more to it. Advanced packaging is currently only 4% of the entire semiconductor market. Even if you dominate it, the pond is still quite small. Long-term growth doesn't depend solely on great execution for Besi, although that helps. Growing over decades also depends on whether the market itself is expanding. That's why trends like chiplet architectures, HBM, and 3D stacking matter so much for Besi. If these technologies take off, the pond gets deeper. If not, even a category king can only grow so far. Besi taught us that you can be world-class in a niche, but if the niche doesn't grow, you won't grow much either. Lesson 25. You versus the government. Some companies battle competitors. Edenred battles regulators. And that entirely changes how you should think about its competitive advantage. Edenred has one of the strongest two-sided networks in Europe and Latin America. Employers, merchants, and millions of users all tied together through meal vouchers, mobility solutions, and digital benefits. In most industries, this would create an incredibly powerful competitive advantage, and it is really strong. But Brazil capped merchant fees and considered opening the market. France regularly reviews exclusivity rules, Romania changed its voucher system, and every time regulators intervene, they directly change the economic engine of Edenred. If the government decides to rewrite the incentives, even a strong network effect can be weakened overnight. We don't like that at all. Edenred taught us that a moat built on regulation is also very vulnerable to regulation. Lesson 26. Keep it boring and simple. Retail isn't dead, if you ask us, although we are going online more and more. European discount chain Action shows that when you combine obsessive execution with value discipline, brick and mortar can still do great in a world that is moving digital. Action is far from luxury and doesn't rely on branding. Action wins by operating its stores by focusing on efficiency. It sticks to great low prices, relentless cost control, fast store openings, and scale economies shared directly with customers. While many retailers blame Amazon or macro headwinds, Action built one of Europe's strongest retail machines by doing one thing exceptionally well: delivering unbeatable value again and again. 3i Group, and including Action, taught us that retail modes are about being consistently better, faster, and cheaper than everyone else and returning it to customers. Lesson 27. Valuations still matter. Lam Research is one of the rare companies that executes resiliently across cycles. It returns close to 100% of free cash flow to shareholders. It has grown earnings per share at roughly 20 to 25% CAGR over the last decade. It pours billions into R&D to maintain its leadership in etch and deposition. That mix, high reinvestment, plus high returns, plus disciplined buybacks, is the secret recipe of a compounder. But price sensitivity still matters, but for a different reason. If you overpay for a mediocre business, time is your enemy. The business cannot grow fast enough to bail you out, and you likely suffer permanent capital loss. If you overpay for a great business like Lam, you turn a compounder into a bond. You don't necessarily lose a lot, but you endure years of stagnation, while earnings growth plays catch-up to your entry price. Furthermore, with a semi-cap equipment stock like Lam Research, the real danger isn't just the valuation itself. Another big component is cyclicality. If you pay a premium on peak cycle earnings, you face the double whammy of shrinking earnings and compressing multiples. Lam taught us that great capital allocators create massive value, but only a disciplined entry price ensures that value flows to you rather than the previous shareholders. So, the lesson: exceptional capital allocation magnifies returns, but valuation determines how much of that return you actually get to keep. Lesson 28. Unsexy luxury. This lesson isn't about the iconic luxury brand Ferrari. Sorry. Apart from the name, which is just a coincidence, the companies don't have a lot in common. Both companies have Italian roots, and both are related to the luxury segment. While Ferrari produces the iconic red cars and sells luxury goods, Ferrari Group transports luxury products. The company has become a luxury logistics company with worldwide operations. You can think of expensive Rolex watches, precious stones, diamonds, and jewelry. Although Ferrari Group doesn't share their customers due to safety concerns, we're pretty sure you can think of companies like LVMH, maybe Hermes, Richemont, or even Kering. Ferrari Group is the definition of a concealed champion. On the surface, it looks like a dull logistics company, moving boxes between warehouses. But if you look a little closer, you'll see a business with 59% gross margins, 21% EBIT margins, near perfect free cash flow conversion, and 100% customer retention. How is all of that possible? Because their niche is both high value and unattractive to competitors. Transporting diamonds, luxury watches, gemstones, and high-value art across borders is operationally intense and catastrophic if things go wrong. Most logistics players avoid this category entirely. Ferrari Group embraced it. These positions are won by expertise and trust accumulated over decades. A niche that's too complex, too risky, and too tedious for anyone else to recreate. That's powerful. Competitors fell because they don't even want to try. Ferrari Group taught us that some of the strongest moats live in places no one else dares to operate. Lesson 29. Data gravity. In most software as a service companies, short SaaS, upselling depends on adding features, or improving the user experience, or convincing customers to expand usage. In the digital forensics niche, this works differently. Once evidence flows into Guardian, which is Cellebrite's secure evidence management platform, I know that's a mouthful, the entire investigative workflow starts orbiting that stored information. We call this data gravity, and it's one of the most powerful lock-in effects in software. Police departments cannot risk breaking chain of custody. They can't migrate cases mid-investigation. They can't expose sensitive data sets to new tools without months of validation. Entire departments would need retraining. So when Guardian, Cellebrite's tool, becomes the system of record, agencies naturally expand into other Cellebrite tools, like UFED, Cellebrite's extraction tool, Cellebrite Premium, which is a solution for lawful access, Pathfinder, which is Cellebrite's analysis tool, and eventually InsightJets, which is their cloud solution. This workflow lock-in is a lot stronger than app-level switching costs. Once an agency like the FBI's evidence sits inside Cellebrite's ecosystem, switching is no longer a technical choice. It becomes a legal, operational, and risk management decision. And that's why churn is low and net retention rate above 120%. Cellebrite taught us that data gravity is one of the most powerful lock-in forces in software. Lesson 30. Sticky as glue. You could argue about some industries or companies being too boring to analyze. Some industries reward excitement. Well, that is not the case for Wolters Kluwer. Wolters Kluwer operates in legal, tax, accounting, and healthcare compliance. I know, try to stay awake. Areas where getting things wrong is far pricier than paying for the tools themselves. And this creates naturally sticky customers, resulting in low churn and recurring revenue. The products and services are deeply embedded into the workflows. Wolters Kluwer showed us that boring businesses can still be compounding machines. When your software is difficult to rip out and updated continuously to keep up with regulation, you don't need breakneck growth to win. You just need to keep showing up year after year. Wolters Kluwer taught us that the more boring the industry, the more we like it. Lesson 31. Multiple arbitrage. Diploma plc is one of the best examples of multiple arbitrage we've studied. They acquire small, niche, high-margin distributors at attractive valuation, often around 6 to 9 times EBIT, plug them into their decentralized system, improving pricing and procurement, and watch the market instantly re-rate those earnings at Diploma's higher multiple. Value is created the moment the ink dries. Great capital allocators don't need to make massive deals over and over again. They just need to acquire consistent, repeatable ones. Because Diploma keeps deal sizes small and incentives aligned, they can repeat this formula dozens of times without degrading quality. It's highly disciplined compounding. It's not easy to achieve. They rarely make headlines, but have built enormous shareholder value so far. Diploma taught us that small, repeatable acquisitions compounded through multiple arbitrage beat one big swing every single time. Lesson 32. Valuations always matter. Alphabet is a one-of-a-kind business. I don't think we could argue about that. It has search dominance, YouTube, Waymo, Android, Maps, Gmail, Chrome, Google Cloud, and so much more. And a compute infrastructure no other company on earth can replicate, at least for now. It's one of the best businesses ever created. But exceptional companies can still disappoint investors when expectations become too high. At certain points in history, Alphabet traded at valuations that assumed endless growth, with no regulatory friction. When the stock price already reflects greatness, the upside becomes muted, even for such a high-quality company like Alphabet. A world-class business isn't automatically a world-class investment. The price you pay determines the return you get. Alphabet taught us that the strongest moats don't always lead to the strongest returns. if you overpay. Lesson 33. Monopoly-like pricing power. JR Central is a Japanese railway company. It operates one of the most profitable railway lines in the world, the Tokaido Shinkansen, in Japan. It faces virtually zero direct competition. Yet the growth profile is surprisingly limited. JR Central's growth can come from basically three components: the number of people taking the train, the frequency these people take the train, and increasing ticket prices. There's very, very little upside in all three components. Investing in JR Central becomes even more unattractive when you realize they've massively invested in the Chuo Shinkansen project, whose results and utilization are still highly uncertain. They might even cannibalize their own business model. JR Central taught us that monopolies are extremely powerful, but they don't always result in pricing power. Some assets are designed to be reliable, not really scalable. The lesson to take away from JR Central is that a monopoly doesn't always guarantee pricing power. Alright, lesson 34, and also our final lesson of this three-part series, the discount reason. One of the last companies we analyzed in 2025 was Exor, a holding company with a big stake in companies like Ferrari, yes, this time the red car maker, Philips, and a couple others. Investors love to calculate the net asset value, NAV, compare it to the stock price, and scream undervalued. In the case of Exor, the math is seductive. If you subtract the value of the Ferrari stake, the market is practically giving you Stellantis, CNH, and Philips for free. It looks like you're buying euros for 50 cents. But in financial markets, free lunches are very rare. We think the massive discount exists for two very specific reasons: asset quality and governance. First, the so-called free assets might actually be melting ice cubes. As we discussed, Stellantis is fighting for survival in a cyclical car industry against fierce Chinese competition. CNH is loaded with debt and losing ground to John Deere. If these companies don't turn it around, that free value could turn into a liability. Second, and perhaps more importantly, is the family tax. The Agnelli family holds over 85% of voting rights. As a shareholder, you are purely a passenger. You cannot vote for a breakup, you cannot remove management, and you cannot force a sale to unlock that value. You trust the money to the Agnelli family. You simply have to trust that John Elkann knows better than you do. And the market applies a discount because you have zero control over your own capital. Exor taught us that a huge discount to net asset value can scream undervalued, but it can also be a warning sign, so not always a buying opportunity. We hope you enjoyed this three-part series, our final episode of 2025, and what a year it's been. Next year, we'll have 26 brand new deep dives ready for TDI members. We cannot wait to get back to work and are excited to keep growing the community together. If you're ready to expand your investing universe and start 2026 with a head start, we would love to welcome you. So, close your laptop, put away your phone. The best investment you can make this week isn't in a stock, but in a moment. Enjoy the silence, enjoy the company, and be in the moment with your friends and family. We'll be here next year. We'll see you on the other side. Best wishes from Bauke, Matthijs, and myself. Bye everybody.